Thanks for joining us on The Close. I'm Morella Fernandez. Market close in a half hour's time. Let's get to the stories we're following out of the BNN Bloomberg newsroom. Ontario is launching a formal bid to make Toronto the home to a new international defense, security, and resilience bank. The institution will focus on financing the security needs of democratic nations and is being established by European and Indo-Pacific countries. It would serve 40 member nations. The Premier of Ontario, Doug Ford, touted that Toronto would be a natural choice to house the bank due to the city's strong representation in defense-related industries.
If we want Canada to be selected as the host, we need to put forward the strongest possible candidate, and that candidate is Toronto. The Defense, Security, and Resilience Bank is going to be critical for Canada and our allies. As we make these investments, it will unlock capital, speed up procurement, and streamline supply chain. We're going to work together to cut the red tape and regulations to make sure things happen faster, quicker, immediate.
The Academy of Motion Picture Arts and Sciences signed a multi-year deal with YouTube that will give YouTube the exclusive global rights to the Oscars. That starts in 2029 and runs through 2033. The Oscars, including the red carpet coverage and behind-the-scenes access, would be available live and for free to over 2 billion viewers around the world on YouTube and to YouTube subscribers in the U.S. We're watching shares of Warner Brothers and Netflix as well. Warner is advising shareholders to reject the hostile takeover bid from Paramount in favor of the original agreement with streaming giant Netflix. Warner is deeming the Paramount offer inferior and inadequate. Executives from both Paramount and Netflix have argued that they would be the best owners to utilize the Warner library and boost streaming operations. Shares of Hut 8 soaring today after the Bitcoin miner signed a 15-year, $7 billion lease with FluidStack for IT capacity at its data center campus in Louisiana. Hut 8 has also entered into a partnership with Anthropic and FluidStack to develop and deliver more than 2,000 megawatts of AI data center infrastructure for Anthropic. We'll speak with the CEO of Hut 8 at 4:30 p.m. Eastern Time today. Here is where we are on the markets right now. The TSX Composite down just 5 points, so closing the gap where it started earlier in the day, sitting at 31,259. Let's move to the U.S. The S&P 500, a 68-point drop right now. The Dow Jones, a 200-point down day for the Dow, and the Nasdaq, 360 points down today, 1.5%. So another down day for North American markets. Big tech getting beaten back again. Let's find out what else is slamming the Santa Claus rally. Brian Belsky joins us now, CEO and Chief Investment Officer at Humilus Investment Strategies. Thanks for joining us today.
Thank you so much for having us. Good afternoon, Canada.
Why are investors still backing away from big tech?
Well, I think it's a couple things. Number one, I think there are some general concerns with respect to the concentration of tech stocks over the last 12 months. We remain very positive on the technology front, especially AI, for the next 12 to 24 months. I'm sure we'll talk a little bit about that. Number two, I do believe that some of the concerns with respect to what's happening in terms of CapEx and or the lack of clarity with respect to CapEx with AI going forward has scared people. And number three, quite frankly, these stocks have been very strong since the beginning of 2023. You have to remember that technology was crushed in 2022, mostly because of where valuation was and where inflation and interest rates were. But the snapback rally in 23, the AI-induced rally in 24, the very, very volatile trading that we've seen this year because of what's happened in terms of first the tariffs and then right back on the AI train again. I think a lot of investors are a little bit nervous in terms of the volatility, but we think we're still in the second or third inning of AI. And we think the Santa Claus rally that everybody was talking about, really the Grinch, quote unquote, has taken over. That's for sure.
Yeah, we can see that. Do you see this trend continuing into 2026? Do investors tend to reset at the start of the year?
They do tend to reset. It's a wonderful question. In Canada, you have RSP season, and a lot of investors want to look to longer-term money. We would continue to say to buy those best companies. I think the major difference between 2026 and 2025 is going to be this notion of the term dispersion. A lot of investors don't know what that means. I think that the best way to be able to explain it is not every tech stock is going to go up. It's going to be really difficult to buy a broader index. It's going to be all about owning individual names, not Google and Meta, for instance, just maybe one of them, not Netflix and something else, maybe just one of them, not AMD and Broadcom, maybe just one of them, just to name a few of what everybody wants to talk about. In Canada, we think that benefits Canada because Canadian strength has been so dominated by materials and financials this year. We do think energy could do better in 2026, especially as global growth comes back. And then lastly, we do think that banks in Canada are not going to be as strong as they were in 2025, principally for two reasons. Number one, 2025 outperformance has really been driven by the majority of banks over-reserving. They set aside too much money. And number two, we've had a big valuation move in some of these big Canadian banks, and some of them have very differing fundamental outlooks. So we do think it's going to be actually more of a stock pickers market within the 6 big Canadian banks in 2026.
Okay, I do want to get your take on the wider U.S. economy. Inflation numbers get released tomorrow. Do you expect much of a market reaction?
Well, the market clearly reacted to the unemployment numbers that we received. Now, remember, the Fed has a dual mandate in the United States, inflation and the unemployment situation. And there's a lot of volatility with respect to what numbers to believe in the unemployment situation, especially given that the volatility of the BLS numbers, number one, and number two, the government shutdown. And you even hear from the Fed chairman himself not really believing the numbers. So inflation needs to be more muted. We believe, I think the market is acting and wanting more interest rate cuts. Remember, we've reared an entire generation of investors that only believe that they should buy stocks because interest rates are going down. We at Humulus don't necessarily believe that. We do believe that stocks are run by fundamentals, not by interest rates. So that's why we think, from an inflation standpoint, we think inflation over the next 12 to 24 months will become more and more muted, and that's the longer term trend. Okay,
I do want to get to one or two of your stock picks. Netflix is the first one. And what did you think of the Paramount deal? Not a done deal yet, or sorry, the Warner Brothers deal, not a done deal yet. They're going up against Paramount, but what did you think of it?
Maybe they should buy Paramount too. I don't know. No, the Warner Brothers deal, we've owned Warner Brothers for a couple of years in our small mid-cap portfolio that we've overseen for a while. And the issue with Warner Brothers has always been the debt side of things. And Netflix is obviously the greatest content creator, we believe, of the streamers, at least one of the one or two. And we think Netflix, with its cash going forward, is going to be just fine. I think this deal makes a lot of sense. I don't believe that the Paramount noise will get in the way of this deal, and I think ultimately Netflix will win Warner Brothers.
Okay, do you want to get one more pick quickly from you, and that is Google. What do you like about Google next year? Of course, YouTube just got the Oscars.
Yeah, YouTube. You know what's interesting about YouTube? I don't think a lot of people understand that YouTube is actually bigger than Netflix. And I think YouTube is going to continue to flex its muscles. We believe they're going to get even bigger into sports. The part of the reason why earlier in the year we doubled our position in Google is because investors rushed to judgment and thought that ChatGPT was going to take over search. And that's really Google's core business, at least in the beginning, but they kind of forgot about how great this YouTube business is. And so we think Google is one of the preeminent, not only technology and communication names, but really preeminent names in the world. You got to think, too, that Google brought back a couple of its founders and early leaders earlier in the year, and that really spearheaded them into doing these joint ventures with Apple. and now what they're doing going forward in terms of some other ventures. So we think Google is exquisitely positioned for the next 2 years.
Brian, got to leave it there, but appreciate your time. Brian Belsky joining us.
Thanks so much.
And coming up next, Warner Brothers is advising shareholders to reject that hostile takeover bid by Paramount. We'll bring you that in a moment. Netflix and Paramount continue to fight to the finish for Warner Brothers Discovery. For more on this, we're joined by Evan Shapiro, Media Universe cartographer at eShop.
The media industry, and I turned it into infographics, but I do a lot of writing on my Substack newsletter, Media War and Peace, and a podcast, Media Odyssey podcast, and I turn it into insights that people can act upon to transform the media industry and understand where the trajectory of it's headed.
And you've got some charts for us and some looks for what's going on now with Netflix and Warner Brothers and Paramount. Where is it sitting in your universe right now? This whole deal, not deal, maybe a deal, who knows deal?
Well, there's a couple of different things that you should know about this. First of all the companies who have bid on Warner Brothers Discovery, which include Netflix, Paramount, and Comcast, all of their market capitalizations have fallen dramatically, a combined $135 billion since they started bidding on the company. So that's the market looking at these offers and not really seeing the math add up. Netflix's offer, if it came to fruition, for example, would create $84 billion in debt at the company. And the interest on that debt would be $5 billion a year, just the interest. And so in order for and they're not bidding for the whole company, they're bidding just for the studio and the streaming platform. In order for that deal to pay off for Netflix, the properties that they're buying from Warner Brothers and Max would have to perform at 3 to 5x what they've been performing at over the last 5 years. Paramount's offer, on the other hand, is even larger, and they're a smaller company. And so the idea that they can make the math work on the other side is a little bit illogical. You know, what it demonstrates to me is that both of these companies are kind of stuck in their strategy for the next 5 years on creating the growth that's necessary, specifically in Netflix's ecosystem or in their company. When you look at the fact that at the beginning of this year, they stopped reporting their subscriber numbers, there's a reason for that. And what I've seen in territory after territory is Netflix's viewership over the last 3 years has either been flat or down. So they are looking to transform themselves into an IP factory. They look at Warner Brothers and they see the DC universe, the Harry Potter universe, the HBO Game of Thrones universe. And there you can look at that deal right there. You can see the acquisition cost would be about $72 billion plus another $10 billion in debt. And the debt interest over the next 8 to 10 years is so substantial, it just doesn't seem to counteract or doesn't seem to merit the upside that if a lowered churn on streaming or the increased opportunity around advertising might counteract. So this chart shows you right there that after the course of, this is a 10-year look, after 10 years, at the current offering price, Netflix would still be in the hole by almost $43 billion after swallowing Warner Brothers Discovery.
And you don't think they'd be able to grow because they've brought those two companies together? You don't think they'd be able to grow those numbers at all?
No, there's a number of different reasons for that. So first of all, there's a huge overlap between HBO Max and Netflix. So most HBO Max subscribers already have Netflix, and a lot of Netflix subscribers have HBO Max. And so when you combine those two together, the net gain of subscribers probably isn't going to be that substantial. But if you go back to the chart, you see there's a tremendous amount of upside of let's say, lower churn and increased EBITDA from licensing and other opportunities around the world. But the debt interest alone is just so substantial. The model in the same article that I wrote on Media War and Peace, if you look at that article, I use the Disney acquisition of Fox as the comp. And they're very similar. The price is there you go. Thank you. The price is very similar, and it had less of an upside, but you can see that Disney has ended up, since they bought Fox, worth less today than they were when they bought Fox. And so the concept that this massive acquisition is going to solve a whole bunch of other problems, you have to factor in the cost of the debt. And then once you get that levered, the cost of getting new money goes way up. So it's a very confusing set of mathematics if you're looking to make this make sense.
And so you think it's not going to go through then, do you?
I think Netflix, they currently obviously have the lead position to get it. And, you know, the Warner Brothers board. So what happened in the last 24 hours is the Affinity Partners, which is controlled by Jared Kushner, has pulled out of the Paramount offer. So that leaves Paramount short a decent amount of cash, somewhere around 10, 15, $20 billion short of where they were. So they're going to have to replace that value somehow, which is probably going to have to come through debt, which makes their offer less attractive. The second part of that is the Warner Brothers board, based on a lot of the risk that the Paramount offer has rejected the Paramount offer. Now, Paramount's offer is a tender offer. They're going directly to the consumers to try to create a hostile takeover of Warner Brothers Discovery. So they're offering the shareholders $30 per share, which is higher than the $27 and change that Netflix is offering. But they have to convince a huge section of the shareholders to get it. That leaves Netflix in the lead position to get Warner Brothers Discovery, but the president of the United States has come out against the Netflix offer, saying that any acquisition should or must include CNN. There are members of the Congress on the Republican Party who are against this, but then there are members of the Democratic Party in California. The Attorney General of the state of California has come out against this offer as well. So they're going to face headwinds from a regulatory standpoint from both sides of the aisle. They may wind up with it, but it's going to take most of 2026 to close it. And I wouldn't be surprised if some other buyer popped out of the woodwork as this is spinning around. Most notably, I think, honestly, the company that makes the most sense would be Apple. They have tons of cash. There's very little overlap between those two companies. It would probably face fewer regulatory hurdles, but that's just my own conjecture.
Evan Shapiro is with eShop. Coming up, oil prices rising today after U.S. military pressure on Venezuela. The U.S. President Donald Trump ordered a total and complete blockade of all sanctioned oil tankers entering and leaving Venezuela. Let's get more from Bob McNally, founder, president of Rapidan Energy Group. Thanks for joining us today.
Great to be with you, Marilla.
Do you anticipate a regime change in Venezuela?
I do. Rapidan has put 70% odds that in the coming weeks to months, Mr. Maduro will leave one way or the other. President Trump has the means, and it is increasingly clear the will to see through regime change in Venezuela. And we think odds favor, not a certainty, but odds favor that outcome.
Okay, we had West Texas Intermediate hit a new low yesterday, under $55 at one point. It's moved back a little bit today, but how much of a difference will a blockade on oil from Venezuela affect the supply in the market?
Not by much, Marilla. You know, in some ways, the president's Truth Social announcement of a complete and total blockade on sanctioned tankers is really just restating what's already been in place since the United States seized the Skipper, a sanctioned tanker, a while back. Since then, we've known for days now that sanctioned oil tankers, which aren't all of oil tankers, are not welcome and are vulnerable to being seized. So by saying sanctioned, the president indicated he's not going further than we have already. But you know what? Even if the president declared a total blockade and we lost all of Venezuela's roughly 800,000 to 900,000 barrels a day of exports, that's pretty small in the bigger picture. And as you mentioned, oil prices have been falling because traders are expecting this oversupply to materialize at the range of 2 to 3 million barrels a day. In that environment, the loss of Venezuela, it's important for China, which has made a lot of money buying Venezuelan barrels at a discount. So it's not a good day for China, but for the broader oil market, for consumers, for oil prices, even the total loss of Venezuela wouldn't be catastrophic.
Okay, so China could easily make that up somewhere else?
Yes, China could go to the Middle East and say, look, I lost my Venezuelan heavy sour barrels. I'd like some more from you, Iraq, UAE, and so forth. There are other customers. Venezuela accounts for about 4 to 5% of China's total crude imports, and it can replace them pretty easily.
Okay, so what about the possibility of an agreement between Russia and Ukraine to sort out that conflict? How does that Russian oil change the outlook for the world?
You know, it's a big difference as to whether we get a ceasefire, like in the end of the Korean War, in which case we wouldn't expect sanctions to be removed. Russian natural gas would not flow back to Europe. Those sanctions on Russian exports of oil and refined products wouldn't really end. Or a peace agreement. That would be ideal, where we have a true settlement, like after World War II. I think a peace agreement is unlikely. The sides are very far apart. What's really on the table is an armistice. And in that environment, I don't think too much changes on the energy front. We won't see a relaxation of sanctions, certainly that the EU has, as long as there's just sort of a cold peace or an armistice where both sides are fully armed, staring at each other over an armistice line, not fully at war, but not at peace. No big change.
So what would your price target be for West Texas and Brent crude for the start of 2026, considering how many factors are sort of affecting the oil market right now?
We're looking into the high 50s dollar per barrel range. For Brent, we're looking at a low of around 55. That means for WTI, $52, $51 per barrel. And that assumes, very importantly, that there are cuts in production, because this market is oversupplied, we believe. We believe that either OPEC Plus, led by Saudi Arabia, will have to implement production cuts. So far, they've been increasing production, although they paused now. Or President Trump will start to tighten sanctions on Russia, Iran, or Venezuela to remove oil. If we do not see oil removed, either from OPEC Plus or from sanctions, then my price target would go lower for crude. We will have to go to levels that start to hurt U.S. shale oil producers.
And what level is that?
Well, that level starts in the $35, $40 range for some of the shale plays. We get down into there, and you'll start to see shale wells shut in. Not just new rigs get postponed, but actual production start to slow down. You know, in 2020, oil prices went to $20 a barrel, and we lost the United States over 2 million barrels a day pretty fast in a few months then.
All right. Bob McNally, I got to leave it there. I'm out of time with you, but thank you for your time. I appreciate it.
Thank you.
Coming up next, the closing bells on Bay Street and Wall Street. Here are the closing bells for the end of the trading day. At the NASDAQ, Tiziana Life Sciences ringing the bell. In New York, it's the executives and guests of ADL and J-Lens in celebration of the recent listing of the TOV ETF. You're watching The Close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX ending the day 13 points down at 31,250. The S&P 500 a 78-point drop, so over 1% to 6,721. And the NASDAQ a 418-point drop, 1.8%, taking it to 22,693. Let's get to the movers in Toronto. We'll start here with Cargo Jet, up more than 6% or $4.73, taking it to $80.28. But it's down 25% on the year. Curaleaf, a cannabis company, still bouncing around and gaining on news in the U.S. that there could be a change in regulatory information around cannabis. So Curaleaf gaining today 4% or 26 cents. Baytex moving up today as well, gaining 4.5%, 19 cents to $4.34. On the flip side, TransAlta down today on a demand out of the U.S. that the company keep its coal-fired plant running in Washington state for another 3 months longer than planned. That dropped the stock $1.01 per share. So 1768 is where it lands, 5.4 move down. And Toromont is also down today, 5.6%. It lost $9.47, taking shares to 158.47. Ottawa has approved the merger between Anglo American and Vancouver-based Teck Resources Limited. Abigail Beeman, CTV, has more on that.
What Anglo Teck was offering was not enough.
A sharp turn from last month, the industry minister has approved the merger between Anglo American and Vancouver-based Teck Resources Limited under the Canada Investment Act. In a statement, Jolie details why she now believes the merger is of net benefit. The companies agreed to invest at least $4.5 billion in 5 years and at least $10 billion in Canada within 15 years. The headquarters will be in Canada, as will 2/3 of senior executives. And the 4,000 current Canadian jobs will be secured, plus 2,900 new jobs through the Highland Valley Copper Mine Life Extension Project. BC's premier recently visited that project, now calling the merger great news for BC, with Anglo Teck the largest company in the province's history.
Our salmon watersheds are facing mine pollutions.
Environmental advocates like Northern Confluence will be watching carefully, concerned about water pollution and calling for better regulation.
There's also a bunch of liabilities that come with this takeover, and we really need to make sure that British Columbia holds to making sure that the polluter pays.
This merger will establish Vancouver as the headquarters of one of the world's largest critical mineral producers.
While BC's Mining Association lauds the move.
The name's going to change, but you're going to have a stronger Canadian-based, Vancouver-based global miner with a Canadian flag on it operating here in our country and around the world.
A cultural loss. It may be headquartered in Vancouver, but it's a global mining company now, even more than Teck was before.
Teck Resources was one of the last big Canadian mining companies. It declined interviews today.
Abigail Beeman reporting there. Technology stocks took a hit today and drove major indexes in the U.S. lower. My next guest believes the Christmas rally may simply be late this year. Let's go to Adam Johnson, founder, author of Bullseye Brief. Thanks for joining us today, Adam.
Oh, great to be with you, Morella. Thanks for having me.
You say algorithms are pushing down tech stocks. Explain.
Oh, absolutely. So I'm long a lot of AI stocks right now, as I'm sure many of our viewers are. And this morning at about 10:30, all of a sudden, the NASDAQ dropped about 3/4 of a point. And when I looked to the side of my screen, what I noticed was that 8 of my, call it 10 AI names were all down instantaneously by exactly the same amount. When you see 8 different stocks that are all down, call it 7%, within 1 or 2 basis points, in other words, one's down 7.01%, another's down 6.99. When you have 8 stocks all down by exactly the same amount, that's not people making sales. That's computers making sales that are specifically shorting stocks in very specific amounts to keep those amounts that they're short in line. That's why the prices are going. It's highly controlled. And I think what's driving it is this notion that we're spending too much on AI. No, we're not. We can afford it. And number 2, that AI stocks are trading too rich. Actually, no, they're not. Nowhere near the valuations we have seen during previous bubbles. But it only takes people to start talking about that for the computer programmers to start programming for headlines that look for negative commentary, for example, on Twitter, and all of a sudden they start seeing that surge, and then the computers go out and start shorting. And the more they're able to short, the more they do short, and then all of a sudden you have a bunch of names that are down 7-8%. That's why I think it's computer driven.
Okay, so this was kicked off, of course, by sentiment. People are worried about CapEx spend into AI. They're worried about valuations, as you mentioned. Do you see this the sentiment carrying into the new year?
It'll run its course. Does it carry into the new year? Does it end next week? Here's the way I'm looking at it. If you remember about 9 or 10 months ago, everybody freaked out over China's deep seek. We thought, oh my gosh, the Chinese are going to just tear GPT to shreds. They're going to do it for free, and maybe the whole AI trade is over. And then we ultimately learned that the Chinese built DeepSeek on the back of 2,200 NVIDIA chips and code that was stolen from ChatGPT. So it all came right back to the US. And once we got comfortable with that notion, we realized, oh, no, the AI trade isn't over. It's only just begun. And the AI stocks like NVIDIA, or led by NVIDIA at that point, went on to new highs. Well, right now we've got this freak out about spend and valuation. And I think once we get comfortable with the metrics around spend and valuation, I think the selling will have exhausted itself, and value buyers like me will continue to buy and ultimately drive these stocks higher.
Okay, so what are you buying now?
Oh, take your pick. They were all down. Applied Digital, which builds data centers. CoreWeave, which rents out AI capacity in data centers owned by Applied Digital. Sterling Infrastructure, which was down crazy, like 11% today. They build data centers in part for Applied. That stock is growing, oh gosh, 25, 30% and trading at like 20 times earnings, really? GE Vernova, which powers data centers. It's a spinoff from the old GE, where they basically take a jet engine, instead of running jet fuel through it, they run natural gas through it. And instead of creating propulsion, they just spin a turbine that ultimately generates electricity on site. So we've sold the whole question about how do we power data centers. So my point is, there's an entire ecosystem around data centers. And did you know, in those four names, I didn't even mention NVIDIA. So there's a lot more to buy than just NVIDIA.
Okay, what are you not buying these days? What do you see as stocks that you don't think have a long runway in 2026?
Yeah, fair question. Well, one of the other questions, I mentioned GE Vernova, which you're showing for viewers right there as a way to power data centers. One of the trades that's kind of been making its way around Wall Street is the small nuclear reactors, on the assumption that, like GE Vernova, we could actually create power sources right at the data centers, right where they're needed, or for that matter, any factory. And the technology does exist. I mean, nuclear submarines use small nuclear reactors. But the problem is, it's very hard to actually commercialize these things, and it takes a long time to build, not just to get the permits, but also to build. And so if you look at the small nuclear reactor stocks, they're likely not going to generate revenues, any serious revenue, above $1 billion. They're not going to generate that kind of money for 3 to 5 years, which means they're not going to generate profits for probably 5 to 7. And guess what? I don't want to own companies that can't make money for 5 to 7 years. That just doesn't work. And you know what? I would say the quantum computing stocks are in the same boat. It's very exciting. And who knows? Maybe one day quantum computing will replace my beloved NVIDIA GPU chips. But until that happens, and again, quantum computing is far from proven. Until that happens, I don't think you can own the quantum stocks. They've all come way down, as have the small nuclear reactors.
Okay, give me your big picture look for 2026 for the U.S. economy. You've got the rate cut that happened, jobs, the labor market's weaker, but you also will have the offset of the one big beautiful bill. What's your take on what's ahead for the U.S. economy next year?
There is far more to like than to fear. Just start at the top with GDP. We're growing at about 4 to 4.2%. That's very impressive. And I think it's going to accelerate. And it's going to accelerate because earnings right now are growing. They've grown double digits for the past 4 quarters. I think that Q4 will mark a 5th consecutive quarter. And profit margins are at 15 to 20-year records, about 13.2%. In spite of tariffs and inflation, I think that's the payoff, the initial payoff of AI. We still have the vast majority of people working in this country. I recognize unemployment did tick higher in the most recent data, but that's because the labor force got bigger. More people are being counted. So as long as you have people gainfully employed, making record incomes and spending record amounts, that's driving consumption. 2/3 of GDP is consumer driven. And that also is very good for businesses that will keep generating these earnings and record margins. So it's not a perfect world. there geopolitically is a lot that's uncomfortable. But if I look at just the numbers, if I look at what AI is doing for productivity, if I look at what inflation is doing, which is coming down, if I look at interest rates that are likely to go lower, I see a lot more to like than to fear.
Adam Johnson, sir, got to leave it there. Adam's founder and author of Bullseye Brief. Thanks for your time.
Thank you.
Coming up next, we've got the latest earning results from Micron. We'll bring you those numbers in just a moment. Coming into the newsroom, Micron Technology reporting first quarter results. Adjusted revenue coming in at $13.64 billion. That's a 57% year-over-year increase. The estimate had been for $12.95, so a very big beat on adjusted revenue right there. You can see stock moving up in after hours. Adjusted earnings per share coming in at $4.78 versus $1.79 year-over-year. The estimate had been for $3.95, so again, another big beat on earnings per share for the company. Adjusted operating income coming in at $6.42 billion versus $2.39 year-over-year. The estimate had been for $5.37, so again, another big beat. Cash flow from operations at $8.41 billion. The estimate had been for $5.94 billion, so a lot of cash flowing there. R&D expenses coming in at just over $1 billion, $1.1 billion. So 32% year-over-year increase, and the estimate had been for 1.15. They actually spent 1.17. Adjusted operating expenses, $1.33 billion, up 27% year-over-year. The estimate had been for $1.34 billion, so a bit of a miss right there. Forecast: Micron sees second quarter adjusted revenue coming in at $18.3 billion to $19.1. The estimate was way down at $14.38 billion. And as we mentioned, shares are moving up with the big beat in after hours trading. Demand and supply shortages allowing the company to charge more for products. All right, let's take this to Dan Ives, Global Head of Tech Research at Wedbush Securities. Thanks for joining us, Dan. Let's talk about Micron. What have been the tailwinds for the company?
Look, it's at the center of the AI revolution, right? And I think if you look at these numbers, just further validates what we're seeing in terms of spending. Like demand and supply is 12-1. You know, when you look at for NVIDIA chips and you look at across the sort of ecosystem from AMD to Micron to others, we're still in the early innings of this AI revolution, despite some of the nervousness.
Okay, so they're up 175% so far this year. Do you think the strength will continue into 2026?
Oh, yeah. I mean, look, there are the Ives AI 30, one of our top names on the semi side going into next year. To me, like they're just hitting their stride, you know, relative to where they play in the centerpiece of a lot of these AI build outs. But I think it's important to remember, like only 3% of U.S. companies have gone down the AI path. And you think globally it's less than 1%.
Got it. Okay, so a lot of room to grow. Let's get to Tesla for a moment. Shares reached a new high yesterday, and you say there could be a monster year ahead for Tesla. Is that on robocabs you're thinking?
Yeah, look, it's all about autonomous and robotics, right? I mean, that's really the key. But when you think about physical AI, the two best players are NVIDIA and Tesla. And I think, you know, they're now going into just a massive chapter of growth when it comes to the autonomous world. Robotaxis we expect to be in 30 cities, you know, in 2026. Hey, look, and I think this is the key why you own Tesla. You own it for robotics. You own it for, you know, what ultimately is Optimus. And I think you're just starting what's going to really be a historical year for Tesla, especially with Musk right now as wartime CEO.
How successful has the rollout been in Texas?
Look, we saw it firsthand. I mean, I think in Texas, it's been very successful. You've seen the geofence area expand pretty significantly. No safety driver, which is really important. And I think as that all plays out, you know, that's going to be a model that we're going to see across other cities. And you know, we talk about base case $600, bull case $800 for Tesla.
Okay, so how quickly do you think this could happen? If they're starting in Texas, they want to roll across the country. How soon could we start seeing some of these robocabs in the major city centers in the U.S.?
I think by the spring, you're going to see a number of them. I think, we talk about 30 cities, probably by the summer, 2026. And then I think you start that volume production of cyber cabs. Look, and that's really the key right now. If you look at Tesla, if I told you beginning of the year where numbers were going to be in terms of earnings and revenues, you would have thought the stock would be $200, $250. The reason it is where it is, it's all about autonomous. This is the AI revolution now coming to Tesla. And I think it's just such an important time for Musk and Tesla as we go in 2026.
Dan, what about regulation state by state, which would be different and be perhaps hard to maneuver?
Yeah, it's a great question. I think that's really going to be federal. I think similar to what we're seeing on some other areas, from executive orders from Trump, I think you're going to see more of a federal roadmap because that's important. When you think about what's happening in China, in this AI arms race. So regulatory is going to be important. I think we start to see that early next year, call it. And this is something that's just so important for Tesla, just given if you think about it over the years, it's all been the build up to can you get to true autonomous? And that's, I think, where we are as we go in 2026 for Tesla.
How much of a market do you think Tesla can get in the robocab sector?
Look, I think globally, 70, 75%. When you meant the global autonomous market. Look, China, obviously, you're going to have a lot more competition. But I think no one can match the scale and scope of what Tesla brings. And that's why we're so bullish in terms of what this means. We talk about $2 trillion as our base case, $3 trillion as our bull case. And I think it's important for everyone to understand, you'll have some white knuckle moments like we have this last few weeks in tech. We believe this tech bull market goes on for another 2 years, just given this fourth industrial revolution.
Let's talk about the other part of robotics. Robocabs are one. What about the other robotics? Where are they seeing progress? What do you see in 2026 on the robotics side?
Yeah, Optimus. Look, some would say that that's even going to be bigger than autonomous. And I think when it comes to what we're going to see coming out of the factories where you start that production, that's when you look at Optimus, that's going to be important on the consumer side as well as for factories, industrial production. And I think that's something where humanoid robots is something that is not 10 years out. It's not 5 years out. It's actually a lot closer. I think Tesla's going to play a huge role here.
And you see them being rolled out to do a warehouse kind of jobs?
I think that'll be one component. And then in the consumer household, you're going to see humanoid robotics in the next few years. I think you're going to see it play a big role in warehouses, from an industrial perspective, production, and I think it speaks to just this new world that we're seeing. But also, I think some of the worries are, does it take jobs away, and obviously some of the natural worries there. I think especially in the U.S., it's actually a net job creator. When you think about AI revolution, just given the innovation cycle overall that's coming to the U.S.
All right, let's talk about cars, right? They produce cars, and I'm wondering how more they will achieve in that market. They were pushed down in the start of the year, of course, with the sentiment against Elon Musk. But do you think there's more market share or a lot more market share for them to grab there?
I'd say stabilization would be the best way I could talk about. Now, look, Ford, GM, definitely pulling away, from that market a bit, just given what we see on EVs. And that's positive for Tesla as they go after market share. There's still brand issues in Europe. China, you're seeing an improvement there. So I would think about it like some net incremental market share. You also need to see rollouts of new vehicles. That's going to be very important for Tesla, especially in 2026. Look, that continues to be their core business. But when you look at the future, 60, 70% of future earnings will probably be autonomous and robotics.
So things are changing dramatically, you think, for Tesla next year. Dan Ives, got to leave it there, sir, but appreciate your time. Thank you. Up next, General Motors, Stellantis, Ford, all scaling back EV plans, as you just heard. The Trump administration proposing to mitigate fuel economy rules that would cause less demand for those markets. Back in a moment. Ford's going to take a $19.5 billion U.S. write-down, as well as killing several EV models, as the American president's policies continue to reshape the EV market. We were joined by Garrett Nelson on this, Senior VP and Equity Analyst at CFRA.
A bit surprised by the magnitude of the write-down. $19.5 billion is a lot, especially considering that Ford didn't have the EV investment or exposure that General Motors had, for example, their arch rival, and many other automakers. So, Ford has kind of taken a more balanced approach compared to some other automakers in growing both their hybrid exposure and their pure battery EV exposure. So we were a bit surprised by the magnitude of that. That said, we have seen write-downs from other automakers. GM took about a $1.6 billion write-down in October related to their EV assets. So it wasn't surprised that they took the write-down. The magnitude was a surprise. And the big positive was, commitment to really growing their hybrid portfolio longer term between now and the end of the decade. That's the vehicle type, the powertrain type that's really in demand among consumers right now.
And just going back, any indicators as to why the write-down was so large?
Yeah, I mean, it's related to their battery investments, some plants that had been converted to EVs. So, they were taking those steps, and basically, last November happened, and President Trump won. And so, shortly after that, obviously, you had the Trump administration and Republicans, take steps to end the federal EV tax credit. It was a $7,500 EV tax credit on new vehicles. That expired at the end of September. And so I think that's why you're seeing in the aftermath of that, some of these impairments being taken.
And now we still see, we see Chinese companies really pushing for EVs. Europe still is, although Volkswagen just kind of backed off just an announcement on their battery business. They're trying to find external funds for it. Is this the way to go in the North America, I guess? Is there a market for what they're looking for with the hybrids and for the extended EV? I think they still want to do the extended range as well, right?
That's right. Our take is it was always a little bit too early, and that the hybrid was going to be sort of a bridge vehicle between internal combustion engine and electric vehicles, which we still do think is the future of the auto industry. But this is a move really intended to cater to what consumers are interested in. The good news for Ford is they have had a lot of success with their hybrid models, mainly the Maverick pickup and the F-150 hybrid pickup. They've had a lot of success. And they plan to introduce hybrid models of other vehicles, in the coming years. So they've had more success than some of their other competitors, but still they lag behind a lot of the Asian automakers, which have made a heavy bet on hybrids. You're talking Toyota, Honda, Hyundai, Kia. Those are the companies that we think are really going to benefit in terms of market share gains over the next few years because of the very heavy investments that they've made in hybrids, sort of shunning EVs in the process relative to other automakers.
Now, what do you like about the hybrids that you think that may be the future, and can Ford catch up to everyone else there?
Yeah, for one, they're just much lower priced than the pure battery EVs because the battery is much smaller. They have a battery. In a lot of cases, these vehicles are capable of going 40 to 50 miles on pure battery charge. And so, you think of the average person might not drive 40 or 50 miles in a day. And so they could essentially drive on battery only charge without using any gas. So that's a big positive. And then the ability to, I guess number one, the lack of charging infrastructure, the build out's just not there, especially in certain areas of the country. And then the ability to take a long road trip and not having to stop for a long period of time to charge the battery. So there are a lot of, but the main reason is probably the price point, and that's why consumers have shown more interest in hybrids. And we expect it to be the fastest growing powertrain type by a wide margin over the next few years as a result.
Garrett Nelson, Senior VP, Equity Analyst at CFRA. Coming up next, energy infrastructure platform Hut 8 signed a $7 billion lease with FluidStack for a data center. We'll talk to the CEO in just a moment. Hut 8 has signed a 15-year, $7 billion U.S. lease with FluidStack. Let's talk about that with Asher Ganut, CEO of Hut 8. Thanks for joining us today, Asher.
Thanks for having me. Excited to be here.
So this centers around a site in Louisiana. What's currently there?
It was a hunting ground before that had a lot of transmission line and power capacity. And so we actually bought about 600 acres of land. And then now we have an option to scale that to 3,000 acres.
Okay, and the deal is with FluidStack and Anthropic. Can you explain the role of each in this process and what you're building exactly?
We announced two deals today. We announced a strategic partnership with Anthropic and FluidStack to build 2.3 gigawatts, up to 2.3 gigawatts of capacity at Anthropic's option to be able to scale and to support their computing needs, starting with this 245 megawatt campus. Then we announced a signing of this actual campus. It's a $7 billion deal across a 15-year tenure, and that deal is fully financially backstopped by Google and their credit. And that's the full $7 billion in addition to other pass-through costs as well.
Okay, so what's the timeline for the build?
The timeline is building throughout 2026, and the campus will come online throughout 2027.
Wow, so that's quite that'll be quite quick. Are you guys positioned to do that already?
We are. We have great partners. We announced, in addition to it, that the financing, we're partnering with JP Morgan and Goldman Sachs. We'll get 85% financing at SOFR plus 225 target. And then in addition to that, from an operating perspective, Jacobs is going to be our EPCM partner to design and build the facility with local subcontractors that we've already partnered with. And then Vertiv is going to supply the supply chain for long lead time items. So we announced a holistic deal and the full execution agreements to deliver that project as well.
Okay, so you've repositioned yourself to provide energy for the AI build-out. Where have you had success so far previous to announcing today?
We've built a large energy infrastructure platform. We have about 1,000 megawatts of capacity online today. About 700 megawatts supports Bitcoin compute, 300 megawatts of power generation and 4 power plant supporting the Ontario power grids. And then we have 5 co-location data centers in our platform today. When we look at our development pipeline, the total pipeline, including the gigawatt that we have today, is about 9.5 gigawatts of capacity. So we really understand power, how to develop projects, and really ultimately it's what is the technology that is best suited to consume that power, and we sit at that intersection between power and technology and build infrastructure to be able to support it.
Can you give me an example of that? Because you make a good point, sort of what power you need for what. Give me an example of how that would work.
So if we think about compute, today we have data centers that support ASICs that power the Bitcoin security network. But now we have data centers that support AI compute that are GPUs or TPUs that power AI compute. In our co-location data centers, we actually have normal CPU data centers that power everyday servers for our customers as well. And so as we think about that side of the business, it's really powering compute of all types. However, we also believe long-term that you'll continue to see increases in use cases, especially with the reshoring of advanced manufacturing. You're looking at a lot of LNG facilities. You're looking at liquid hydrogen nitrification. So you'll see a semiconductor fab manufacturing. All of these facilities being built in the United States will require more consumption of power, and that power, as a result, and that infrastructure needs to be built. I think a common misconception is an increase in power consumption is bad. I was actually with an energy executive from PJM, which is the utility in Pennsylvania, and they said that their calculations show that a gigawatt of additional power demand from data center demand actually decreases the energy rate by about 10% for their residents who are paying energy bills. And so we're excited to support that continued growth of technology through the scaling of power generation and use cases.
Because you were a Bitcoin miner, what has been the biggest challenge for you to pivot?
Probably credibility and building the relationships of trust that we can build infrastructure at scale. We started this endeavor about 2 years ago, and it took us that time to build the trust amongst the customers, where now we've announced one deal with a customer, but have many others that we built relationships with as well, and being able to deploy and execute for them. The great thing about Bitcoin is two things with that background. One is we have a lot of access to power. We really understood power. And the second is we really understood infrastructure. We built substation capacities. We built all of this high voltage, medium voltage electrical work. And people are starting to see that that technical ability and construction ability actually has a lot of impact and use cases to the benefit in deploying these assets at this speed.
Interesting. All right, Asher, I got to leave it there. I'm out of time with you. But thanks for joining us. Asher Ganoot, CEO, Hut 8. Coming up next, the federal government has signed a memorandum of understanding with Canadian artificial intelligence platform Coveo to boost innovation and to integrate Canadian-built AI into government operations. Back in a moment. Montreal-based AI leader Coveo and the Canadian government announced a memorandum of understanding to boost innovation and adoption of AI. For more on this, we are joined by Louis Tetu, who is the chair of Coveo.
What the government is very intentional about right now, Roger, is the idea of modernizing the government with technology and AI in particular. There's a significant opportunity to leverage AI technology for Canadians, to help Canadians to self-serve in particular, and help government workers to obtain better information to serve Canadians. And that's a key low-hanging fruit that potentially is $1 billion plus cost savings opportunity for the government, and frankly can give back time to Canadians. And that's what we're going to explore together.
Have you worked with government before? Do you think you'll be met with resistance within it?
Yeah, well, we work across the world. I mean, Coveo is an internationally recognized leader in applied AI, in applying AI models into secure data. We do 98% of our revenue internationally, and we do work in that context with the government of Australia, with the government of New Zealand, with institutions like the City of New York and others, and of course thousands of international brands and so on. So, in particular, with the Canadian government, we've been a provider of fairly basic search engines. We haven't yet deployed generative AI at full scale and so on. But as I said before, Roger, there's a significant opportunity to explore that and something that can be realized, in our opinion, fairly quickly.
How important is it that the government set an example, essentially, when it comes to AI?
I think it's really, really important. Minister Solomon, Minister Lightbound, and even Prime Minister Carney are very intentional about their desire to first create a sovereign Canadian AI infrastructure that is industrialized, so that, number two, the Canadian government can gain the efficiencies it should be looking for from that technology. And three, really being a catalyst for the broader adoption of AI within the Canadian economy. And help basically catalyze, that adoption by Canadian businesses as well as institutions. So for all those reasons, we're seeing the government, as I said, being very intentional and moving very quickly around that. And we're certainly pleased that we're able to see together how we can contribute to that.
Now, we have struggled, though. I read that article you had a couple of weeks ago, I guess it was, and you talked about we have 10% of the top-tier AI researchers in the country, but we're not fully utilizing that and taking advantage of that.
That's correct. I think this is the history of Canada, and it's really great news that there's such a reversal of event. What I often say, and I've been personally involved in building fairly large-scale public software companies across the world for the past 30 years, and I've seen more than often Canada being really, really good at science and research, but failing to monetize and industrialize. And in fact, oftentimes, we've trained arguably some of the best talent in the world, and we've given it away. And we've been a net exporter, I think, of talent and IP. And this was mainly, the observation. I think now there's a definitive, there's a real intent on the part of the government to, really apply AI, industrialize AI in particular, and technology, more broadly into the Canadian economy to transform the Canadian economy, make it more productive, make it more efficient. Let's face it, we are behind, but there's a clear opportunity. I think it's a real railroad moment, the way I say it, for Canada, and I think the current government, I'm certainly pleased to see the current government being so intentional and moving fairly quickly on that, not only with companies like Coveo, but with Canada's talent and IP and technology companies in general. And so I see that we see it as very, very positive, and we think it's going to have obviously a very positive impact on companies such as ours.
All right, it's Christmas time. What more would you like to see from the government to help to further this along?
Oh, I think I would love to see the government, and I've commented on that in those articles I authored in the Financial Post and so on. I would love to see our government stop the nonsense of paying foreign companies to come and hire our talent domestically. I think foreign companies should pay us to hire the produce of our education and come and establish themselves here, because we need that talent. Fundamentally, AI is not a technology war only. It's going to be an energy war, and it's going to be a talent war. And I think we're well positioned to do that, to the extent that we become very attractive to talent. The H-1B in the U.S. is a huge opportunity. Number two, that we produce more talent, and number three, that we keep it domestically within our government, within our institutions, within our businesses. And I think that's what we're going to see. We're going to see more of that, and that's I think a very positive thing.
Louis Tetu, chair of Coveo. Cannabis stocks have been soaring since Trump announced that he could deregulate the drug. After the break, we'll get some hot picks in the sector. Back in a moment. Cannabis stocks have been soaring with reports that Trump is planning on reclassifying the drug. On Hot Picks, we were joined by Kenrick Tai at Canaccord Genuity, and he gave us top picks in the cannabis sector.
The darlings in the cannabis space, a very strong domestic footprint combined with a very large international business. That business is heavily represented in Germany and various other international markets. In terms of their domestic footprint, they really are in the key markets in the U.S., including a high concentration in the Northeast. They have recently signed an agreement to purchase assets in Virginia. As a reminder, Virginia is one of the key catalyst states through the next number of years, with an expected start to adult use in early 2026, which essentially in that first year, Virginia is expected to generate north of $500 million in legal sales, with path to some being a $1.8 billion market over the next number of years. So that certainly is one of those names that has been at the forefront of any discussion around the cannabis space, and certainly a name that we've been positive on for a period of time here.
And sorry, what are their big markets again? Henry, just remind us.
So, domestically, they have a presence across, the majority of major legal states in the U.S. And then in Europe, they have a presence in Germany, the UK, as two of their largest international markets.
TerraSend is your next idea. They're also active in the States. Tell us what attracts you to this stock.
Sure. So TerraSend is a very concentrated play. The beauty about TerraSend is that, they're not in every market in the US, but they are in some of the highest growth markets. Think markets the likes of New Jersey, Maryland, Pennsylvania, Ohio, some combination of either recently legalized adult use markets or markets that are expected to legalize adult use in the short term, specifically a market the likes of Pennsylvania, which I should also highlight Curaleaf, Verano, and TerraSend all present in that market. And that is one of the key states as well to watch over the next couple of years. In fact, in terms of key states, the big catalyst states through any reasonable forecast window here would be Florida on potential adult use, Pennsylvania on potential adult use, and Virginia on the start of adult use sales in early 2026.
And then talk to us about Verano Holdings. They have had a litigation overhang on the stock.
And that litigation overhang has thankfully been resolved. It related to we'll call it a failed acquisition going back a number of years. That was recently settled, which is a big positive in terms of the name. I think on Verano, one of the misunderstood pieces here is just how well represented they are in some very high growth states. They are the number 2 in Florida behind the market leader Trulieve, and yet they trade at a big discount versus the group. This is one of those names that has often been overlooked, and certainly one that I think would warrant further attention.
And sorry, their latest results were a miss, but behind the scenes, you think the company is addressing problems?
Absolutely. If you look at what drove that miss, there was nothing in it that would have caused or would cause me concern or any sort of negative revisions to my outlook, much less to my thesis on the name. These are quality operators with quality assets in some very attractive markets.
And so generally, do you favor retailers or producers, or do you like a bit of both in a company?
Great question. It really depends on how established or how mature that market is. If you look at a market the likes of Maryland, where you have a lot of retail doors opening very quickly, you're going to favor a cultivation forward producer who's actually supplying into those doors versus competing with all of those new opening doors. It's a lot easier to be making money supplying into an explosion of retail than competing with an explosion at retail. So it really does depend, as I said, on maturity of the market, the dynamics within that market. Maryland today is a market where being producer forward would favor you, and that would favor the likes of a TerraSend. There are certain other markets where a fairly balanced portfolio would make some sense.
As you know, before decriminalization and legalization, we heard predictions, well, this industry will go the way of other consumer products industries. Maybe we'll get the big pharma buying it up or the big food companies. Haven't really seen that. I know we have seen major investments by the likes of Altria.
Yeah, and I think that those types of investments, or having big pharma or big ag coming in, that's really only going to be in a sort of federally legal world. I think between here and there, on the back of rescheduling, we see some increased flexibility. I think you can also expect to see some increased focus from institutional investors in the space, big banks focusing increasingly on the space and the provision of a full suite of banking services. But that next level, or that next step, by way of big pharma or big ag moving into the space, I think that's a number of years out and would be built off the back of federal legalization, should that happen.
And broadly speaking, is banking still a hassle for companies in this industry?
Banking is still a very, very, very big problem for companies in this industry. Essentially, you have an industry today that is north of $40 billion at retail, 40 billion US at retail, that is an entirely cash-based, cash-dependent business. Wow. So they cannot accept credit cards. That's potentially changes on rescheduling, should that go through. But just think about the complexity there. Smaller average ticket on cash versus credit. And then, of course, all the cash management and cash-related security concerns. Being a $40+ billion retail business and only being able to accept cash is problematic.
It's interesting. In Canada, the stores, they're legal stores, obviously, at the federal level, they can take debit cards. I'm not sure if they can take credit cards. I assume they can.
Yeah, no, the Canadian market as a fully legalized recreational market, very different sort of state of play and rules of engagement. Certainly the US has significantly higher levels of significantly higher constraints and barriers in the operating for the key players.
Kenrick Tai, Special Situations Analyst, Canaccord. We have earnings results. We just want to recount from Micron today. They came in after the end of the trading day. As you can see, clearly they were impressive for investors because stock is up over 5% at $225.70 right now. So that again, they reported a number of beats in different metrics. Micron, of course, making memory chips, and they gave an upbeat forecast for the current quarter as well. That does it for the close today. Thanks for joining us. We'll see you tomorrow.